This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our introduction to corporation tax, we saw that a corporate tax computation was to be prepared for a UK resident company. And a UK resident company will be liable on worldwide income and gains. So the corporate tax computation includes both income and gains of the company. One tax computation, corporate tax, unlike for us as individuals, income tax on income, CGT on our capital gains. What we've now got to do is to look at the pro forma computation, how it is that we prepare and present that corporate tax computation for what is a chargeable accounting period. And that was the other big issue from that first session of ours, understanding that based on what the question gives you, the company's statement of profit or loss, that is the period of account. And from it, we will need to prepare a corporate tax computation, or as we'll see in the next chapter, chapter 17, from what was a long period of account given in the question, then we produce two corporate tax comps. But again, as we said, we need to know how to prepare one before we can prepare two. So presuming that the period of account equals the chargeable accounting period, what then does that corporate tax computation look like? Well, again, in section C of the paper, we've got that guaranteed 15-mark question on corporate tax. It, though, doesn't have to, probably and mostly will ask us to prepare a corporation tax computation. So here's our pro forma, prepared for the chargeable accounting period. Here, the year ended 31st of March 18. Most of the company's profit, if not in many cases all of it, will come from its trading activities. And that will require those two exercises to be performed that we're used to dealing with for the unincorporated trader. And hopefully, since I saw you last time, you've gone back and revised the adjustment of profit process from chapter 4. And then, of course, having got the adjusted profit, our capital allowances that we saw in chapter 5 to give us the tax adjusted trading profit. But what we said in that context was most, but not all, thankfully, of what we had to do for the unincorporated trader, we also do for the incorporated trader, the company. So before we go any further on this pro forma, let's just look at some of the issues that may go through our trading income figure. Firstly there, royalties. Again, patent royalties that may be payable, royalties payable there, go in line with the accounting treatment, and therefore royalties payable are allowed as a deduction when calculating the adjusted trading profit. So if therefore we are presented with a statement of profit or loss, where debited on that statement, deducted in deriving the accounting net profit, there are royalties payable, then that's fine, that no adjustment would be required. If they told us, here is the accounting profit before dealing with the following, and royalties payable was one of those, then royalties payable are a perfectly normal trading expense and will be deducted in deriving the tax adjusted trading profit. Against that, royalties receivable. We actually own a patent rather than using somebody else's and having to pay a royalty for its use. We own it. Somebody else uses it and we receive a royalty there. Well, those royalties receivable, again, should follow the accounting treatment, working again receivable, so on an accruals basis there, and will be included in the adjusted trading profit, so again, no adjustment required. So any royalties payable, royalties receivable, they're a part of the trading income assessment. More specifically, with this tax adjusted trading profit, as we said, for the adjusted profit big, now we made this statement, I hope, quite clearly back in our first session, but what differentiates it from chapter 4, where most of the rules in fact are the same, is here there will be firstly no private element. There's no private use adjustments, no add back for private use by a proprietor, as there is no proprietor. Equally, there won't be any drawings. Drawings, of course, are not going to be an issue, whether that be in cash or whether it be in goods taken from stock. Not relevant now for companies, as again, no proprietor. Now, there are, of course, owners of that business, and those owners will be receiving dividends, and any distributions, i.e. dividends paid to shareholders, are not allowable deductions and are paid out of post-tax profits. Dividends are distributions paid out of the taxed profit figure. They are not expenses to be deducted in deriving the tax-adjusted trading profit. They are distributions paid out of the taxed profit. There won't be any family salaries to worry about, whether they're paying above or below, usually above, of course, a normal commercial rate. That's not relevant for companies. And then a few specifics that will be relevant for companies that we might not previously have seen. Well, here's one we wouldn't have done. Legal fees regarding the issue of share capital. Actually, companies that have share capital, not unincorporated traders. So any legal fees or other expenses that attach to that, they're an expense only for companies. Now that's of a capital nature, and therefore the expense is disallowed. The expense is disallowed. Legal fees in raising their or that share capital, disallowed and added back in the adjustment of trading profit. If we have incurred such expenses in raising loan finance, then expenses that attach to the raising of loan finance will achieve tax relief. But as we'll see in another discussion about interest income, where interest payable also comes into the scenario, when we look at the tax deductibility of interest payable, it will then depend on whether or not the loan upon which you pay that interest was a trading loan or a non-trading loan. If here now you have incurred expenses in raising loan finance for a trading loan purpose, for example, think what a trading loan might be. Why would you have borrowed money in the context of the trading? Well, you borrowed to buy a property used within the trade, your factory, your warehouse, your office premises, your business premises there. You borrowed to buy plant and machinery and or to increase working capital. All of these are trading reasons, and therefore any such interest payable on a trading loan is absolutely fine. No add back, no adjustment of profit required. That is a perfectly allowable expense. If it's on a non-trading loan, well, we'll come to that separately, then there would be a disallowance in the adjustment of trading profit. You would add back any interest payable that had already been deducted if it were in relation to a non-trading loan. What they might be and what we then do with that interest payable, well, we'll come to that in a moment's time. But here, interest payable on trading loans, perfectly allowable expense. Going back to patents, legal fees with regards to either registering patents and trademarks, again, they by statute are allowed. Interest payable, we've just said, on non-trading loans, added back. Only on trading loans is it, of course, a trading income deduction. But what do we do with that interest payable on a non-trading loan? We do get tax relief, but not here in trading income. Instead, what we do, the expense is deductible against your interest income. So any interest payable on a non-trading loan does achieve tax relief for the company, not against trading income, but instead against our interest income assessment. And again, we'll see more of that in a few minutes' time. So important there to determine in relation to interest payable, what type of loan is it? Is it trading or non-trading? To know exactly where the tax relief will be achieved on the face of the corporate tax computation. There could also be either interest payable to HMRC or possibly even receivable from HMRC in relation to either underpaid or overpaid tax. So interest payable to, treated as a non-trading loan, and is tax relievable also against interest income. Interest receivable from, we've made an overpayment of tax, therefore not only do we get our money back, we get not very much interest, but we get some interest back. That is taxable as interest income. So far as a company is concerned, if it has to either pay or receive interest in relation to under or overpayments of corporate tax, then those figures of interest, whether payable or receivable, they in fact go through your interest income assessment. If as an individual, you or I, had to pay interest on overdue tax, or we received interest again on overpaid tax, none of that comes into the framework of our income tax computation. That's outside the scope of tax. They're separate to it. But in companies, they go through the interest income assessment. Now, to get the tax adjusted trading profit for inclusion on that corporate tax computation, then we also needed to know about capital allowances. And it is the same rules as we saw for the unincorporated business, but no private use assets. And note also in corporate tax terms, there will be only one AIA allowable within. We have to wait till Chapter 22 to see groups of companies, but a group of companies gets only one AIA. We cannot have one company creating a sub and another sub and another sub, splitting out our activities between these different companies and seek to get £200,000 of AIA in each of those companies. No, it's one lot of AIA to be shared around all of the companies within that group. The group does get to decide, of course, where to apply that AIA. They will be able to decide which companies benefit from that. If, for example, the total AIA expenditure all around the group was more than the AIA limit, then we get to choose which of our companies will get the use of that. More about that and something else which reduces profits, the use of losses, and how we make those decisions, well, we'll talk about that again later. Basis periods, not an issue. Not like the unincorporated trader, where we had to relate an accounting period to a tax year. We prepare the corporate tax comp for a chargeable accounting period. That is usually the same as the period for which it's prepared its accounts. We never have overlaps there, and on that basis, there will always be one amount of profit for an accounting period taxed in that one period. We then move to the next period. So it's very, very simple. Corporate tax comps prepared for chargeable accounting periods. Now, those are the key issues in going back to our pro forma computation in getting this key figure. Now, that could be if, say, you got your 15-mark question requiring you to prepare your corporate tax computation. That could be as many as 10 to 12 of those marks, dealing with the adjustment of profits, dealing with the capital allowances, putting together getting the tax adjusted trading profit. That said, it could be a lot less than that. Depends how many transactions you have to deal with. But we're going to have to deal with adjustment of profits and capital allowances somewhere on our exam. It's going to be tested in absolutely every F6 exam, whether it's partly in section A, in section B, or entirely in section C, whether it's for income tax, the unincorporated trader, or corporate tax now, the incorporated, I don't know. But it will be tested one way or the other. So again, your chapter 4 and 5, effectively with these differences, but now repeated for corporate tax, clearly very important. You need to know and you must practice. But the company is taxable on its worldwide income and gains. So as well as the trading income, will include other income. That would be interest receivable and property income. Not, of course, dividend income. That, as we'll discuss separately in a moment, is exempt from corporate tax. What it is income and gains, so the net chargeable gains of the accounting period, i.e. the company might have made several disposals, some of which gave rise to gains, some of which gave rise to capital losses. It is the net gain that is included here. If there were net losses, as we'll discuss later, those net losses would be carried forward to go against future chargeable gains of the company there. So net gains, what you don't need here is that title. You don't need to have other income and gains. All you need to do is to list them out. Trading income, interest income, property income, chargeable gains, any of those that are relevant, and that comes down to an important subtotal there, total profits. That is total profits. That's a need to know figure. Why, you might say? Because it's a figure that's going to feature when we look at losses and loss relief in chapter 18 there, coming up in the none too distant future. Away from total profits, the company might make charitable donations. Now, the company does not operate a gift aid scheme here. It just has qualifying charitable donations where, as long as it's to a qualifying charity, you pay the donation. It's a gross payment. That is the deduction. And according to when they are paid, you get to deduct those donations. They're on a paid basis. Everything else in terms of income, we've worked on an accruals basis. We've taken the statement of profit or loss, the net profit, and we've adjusted it for tax purposes. But the profit was produced using, of course, the accruals basis. Interest income, as well, it's written there, let's make sure we can see that, is on a receivable basis. Property income will also be coming in on an accruals basis. We work on an accruals basis in corporate tax. Again, trying to keep the corporate tax in line with the corporate reporting. So we're working on the same basis there. So take out what has been paid as qualifying charitable donations. You will be clearly told that figure in a question. Then you get your bottom line TTP. That we know is the figure to be subjected to corporate tax. What tax rate? It depends what this accounting period is. Here, it's the year ended 31st of March 18. So I'll ask you, what tax rate would we then subject that TTP to? We need to know that we prepare the corporate tax computation for the chargeable accounting period. And having got the TTP, in calculating the tax on it, we then need to see whether the chargeable accounting period, as here, all falls in one financial year or whether it spans 2 financial years. Here, year ended March 18. That is all in one financial year. Which financial year? I hope I hear you saying FY17. So the TTP should then go on to be taxed at the FY17 rate of 19%. If it was the year ended December 17, then as we saw in our first session, we must time apportion out those profits however many months on a year ended December 17. It would be 3 months at FY16 rate, 9 months at FY17 rate. Not difficult, just a little bit of time apportionment exercise. Other issues, as mentioned here, and as we have spoken of, dividends received from other UK and overseas companies are not taxable. Dividends paid are not deductible. So there's no taxability of dividend income and there's no tax relief in relation to a dividend paid. And one really explains the other. When a company pays a dividend, it is paying it out of a taxed profit. The dividend did not achieve any tax relief for the company. It's paid out of profits that have already borne corporate tax in that company. If that is then paid to another company, then we do not include a dividend paid out of profits that have already been subjected to corporate tax. We don't charge that to corporate tax again in the recipient company. That effectively would be taxing the same profit twice over. We don't do that. There are only very rare occasions, and they don't exist within our syllabus, where certain dividend income could be exposed to tax. But it is very rare. In which case, the dividend paid, no tax relief for the paying company. It's a distribution out of tax profits, and it is therefore not taxable in the hands of the recipient company. Companies, as we kept saying, they pay corporation tax, not capital gains tax on their capital gains. We pay corporate tax on our worldwide income and gains. Right, let's have a look at some of those other components now. which may or may not be included within your exam question. We know that the big one is all about getting the tax adjusted trading profit figure. But we may also have property income. Now, it's the same basic rules as we used in income tax. There we were looking at rental income accrued, less allowable expenses incurred within the tax year. Now we'll be looking at the rental income accrued, less the allowable expenses incurred within the chargeable accounting period. What we also had was premiums received on the granting of a short lease. If you're going to see that in a question, it's probable, in fact, that you'll see it in a corporate tax example rather than an income tax and unincorporated trader situation. So property income calculated on an accruals basis. Interest payable on a loan taken out by the company to buy such a rental property is tax relievable, but remember where. If we had interest payable on a non-trading loan, and an example of a non-trading loan would be a loan taken out to buy an investment, a rental property, then that would be deductible against interest income, not property income. So there is one of the two main examples of a non-trading loan. You borrowed to buy an investment, a rental property, rather than a property used in the trade. That is what distinguishes, that makes it a non-trading loan, and that means that the interest payable goes against interest income, not as you might think, against the rental income derived from that property. If we were talking about income tax, as we know, then that's a separate issue. We have always been able on a rental property to be able to gain relief in relation to the interest paid on the loan taken out to purchase that rental property. We've been able to take that relief against our property income on an accruals basis there. What we now know, coming in the 1718 tax year, and as we dealt with back in chapter 3 there are of course restrictions in relation to interest payable on loans that were taken out for the purchase of a residential property that is then let out. Then we have restrictions, not on commercial property, but on residential property. Equally, for individuals, you could have had an individual renting out a part of their property and getting rent-a-room relief. It doesn't exist, of course, for companies. There's nothing like that here. If a company makes a property loss on its properties, so to begin with, like with income tax, pool all those properties into one. What's the rental income accrued? What's the allowable expenses incurred? If it is more income, as it usually is, than expenses, that is your property income assessment. Put it in the corporate tax comp. If it's a loss, that must be offset against total profits. Total profits, which are, if you remember your pro forma, I'll take you back to it in a moment, before the deduction of any qualifying charitable donations. And that is of the current period. So just to remind yourself, on your pro forma computation, let's just get rid of some of that writing. There are your total profits. And it's against those total profits and before the deduction of those donations that the loss would be applied. So automatically, if you've got a property income loss, an excess of expense over income, then that loss goes against total profits. And total profits, as you can see, is before the deduction of qualifying charitable donations there. If you do make a loss, any excess is carried forward against total profits before, again, qualifying charitable donations of future periods. Now, it's very unlikely that you're going to have a property income loss that is bigger than the total profits of the current period. But if you did, what that is telling you, it is carried forward. What you might get in an exam question is at the commencement of the accounting period, there were these losses that were brought forward. I don't have to explain how they arose. They were brought forward. And one of those is a property income loss. What do we do with it? As it says there, it on this period's computation will go against your total profits of the current period before the deduction of your qualifying charitable donations. On to interest income. Again, we're going to work on an accruals basis. All interest receivable is assessed as interest income. Companies will receive their income gross, so far as our syllabus is concerned. It will all be interest gross there. Interest payable is deductible against tax-adjusted trading profit. If the loan is used for trading purposes, it's clearly a trading profit deduction. For example, to acquire property or plant and machinery for use within the trade or increase working capital. You may remember we mentioned those as the typical examples of trading loans. If we talk about a loan being used for a non-trading purpose, then that is deductible against interest income. And again, we work on an accruals basis. What were our main examples of non-trading loans? One of those we have seen so far. We borrowed to buy a rental stroke investment property there. The other possibility, relevant of course if you're usually dealing with a group of companies and the parent company in particular. A parent company might have grown acquisitively rather than organically. And what it's done is to go out and buy the shares in another separate third-party company. It's become a subsidiary of your group, of your parent company. How did you get the money to buy those shares in that target company? Partly anyway, maybe by borrowing. And if you borrowed to buy shares, that is a non-trading loan, and any such interest payable is a deduction against interest income. The qualifying charitable donations, as we have just seen, these charitable donations make such payments under the qualifying charitable donation system. It will be that in any exam question they will use the term qualifying charitable donations. The paid gross deductible on a paid basis. Now again, we normally deal with an accruals basis for corporate tax, but in terms of that payment, we're talking about there purely a paid basis. Thus, in the adjustment of trading profit, any such payments should be added back and instead included as a separate deduction on the corporate tax comp. Those qualifying charitable donations are deductions from the total of all profit, our worldwide income and gains. We get the total profit, then we deduct the donation. So if you are doing that first exercise, as you will be, deriving the tax-adjusted trading profit, if you've got debited on your statement of profit or loss any such qualifying charitable donations, they are not trading profit deductions. So in deriving the tax-adjusted trading profit, you saw the donation listed as an expense item on your statement of profit or loss. It's not allowable as a trading expense, so you add it back. You increase the trading income assessment. But don't worry, all is not lost. We do get tax relief, but as you've seen here, separately on the corporate tax computation as a deduction of qualifying charitable donations. Where is that deduction? Again, dare I need say it, against total profits. That's where you get the deduction. That's where you get your tax relief. Dividends, as by now we well know. Dividends received from either UK or overseas companies are never included as part of our TTP. They are exempt. So to finish this chapter off, we've got a nice simple little example where you've been asked to compute the taxable total profits for the year ended 31st of March 18. Now again, all this is doing is to test you, do you know your basic structure of the corporate tax computation? An exam question is going to get you to compute one or more of these figures for yourself. That one. the tax-adjusted trading profit. In an objective testing question, you may be given that figure because it then goes on to ask you to calculate the corporation tax and maybe even when you have to pay that tax. But in a proper pro forma computation, maybe the section C question you've got to do, you're given the statement of profit or loss, as we know, you've got to do the adjustment of profits. You've got to do the capital allowances. That area alone could be a handful of marks. It could be up to maybe 10 marks there. So you're going to have to do the adjustment of profits, the capital allowances. Property income. You're going to have to bring in rental income accrued, less allowable expenses incurred. Again, also, if you remember, I hope you do your chapter 3, you might have to include the premium received, or at least the income element of a premium received on the granting of a short lease. If you can't remember or don't know what I'm talking about, go back to chapter 3 and see what that was. Interest receivable, again, should be straight from the question on an accruals basis. If there was any interest payable on non-trading loans, it would be deducted from that interest receivable. Chargeable gains. We will include gains or capital losses. Oh, look, we've got them there. They will give us our net chargeable gains. So here we'd be deducting the 2.5 from the 37.5 and including therefore net gains of 35,000. Gains, losses, how do we relate disposals to a tax year, to a chargeable accounting period? Get that one right, to a chargeable accounting period based on the date of disposal. Whatever assets were sold during the accounting period, here within the year ending 31st of March 18, those are disposals allocated to this accounting period. All gains, all losses must be netted out. If it's a net gain, that is now included on the corporate tax comp. Here, those two numbers, so what, 35,000. If there was a net loss, nil gain would go to your corporate tax comp, and instead, as we'll see in a later chapter, any capital losses are carried forward to set off against future chargeable gains. Dividends from UK companies, or indeed overseas, exempt. Qualifying charitable donations, deductions from total profit. So what have you got to do? You've just got to draft it out. You probably don't even have to write it out. Just understand, think it through, then look at the answer. There's your tax-adjusted trading profit. You've got your property income assessment. You've got your interest income assessment. You've got your net gains. Put those together. Remember, we exempt dividends from companies. Then you've got total profits. Away from total profits, then you deduct your qualifying charitable donations, and that will give you the TTP. This question only asked you to get TTP, but of course in an exam question you probably would then, but always read the question carefully, only do what they ask you to do. You probably, however, would have to go on and calculate the corporation tax liability. This is the year ended 31st of March 18. That therefore is all in one financial year, FY17, and that therefore equals a 19% corporate tax rate that you'd apply to your TTP figure. But have a look through, make sure that you are happy with that. Go back over again, make sure that you're happy with it, and attempt those practice questions there to become more familiar with the preparation and presentation of the corporate tax computation. In our next session together, chapter 17, we'll be looking at that one instance that could occur, and again on a random, if not seldom basis, does come up in the exam, where we have a long period of account. And from that one long period of account, that one statement of profit or loss, we have to prepare 2 corporate tax comps for 2 chargeable accounting periods. Go back over, revise what we said about that, then we can get a head start on chapter 17.